Thank you very much, Simeon. Good afternoon, everyone. It's very nice to be here, and it's very encouraging to be everybody having tea outside as we warm up. I will try to spend my 30 minutes to talk to you about a piece of work that IDEA did for the SADC Secretariat, and be able to show you what we're doing from the users or regulators' perspective. It's been a whole 2 days now when we talk about how great Mojaloop is and what it can do. And now we want to talk about what the market kind of is asking for out there. It is a privilege, an honor, a responsibility, a duty, and a joy to be advocating for real-time payment system. We have been doing this for a while, and at least we've got something to show you around. Great. This presentation is going to talk to you about the mobile money guideline as reviewed for the SADC region. It's very important. We're looking at SADC region, a region that has got countries that are thriving on mobile money and countries that are really thriving on banking and definitely using the payment infrastructure in the region to drive financial inclusion. Now, if you don't get anything out of this presentation, I would hope that you take 3 things. One is cross-border harmonization and alignment, which is one of the key elements that the guidelines actually brought up. Secondly, digitized, centralized KYC. So KYC is a big thing that drives inclusion within the payment systems. And then the last thing is the review of use cases beyond P2P. So if there are 3 things that you need to take away, these are the 3 things that you need to take away. However, I promise you there will be a lot of fun things. We measure inclusion. So we all talk about inclusion and how digital is going to drive inclusion and how real-time payment system drive inclusion, but we normally measure inclusion in numerical figures. It's mostly what we call the averages. By the show of hand, who can tell me where this is? I bet none. No? Huh? Kenya. Anyone else? Okay, great. Simeon? Tanzania. Okay, none of those places. This is not Kenya, this is not Tanzania, but I would like to call that somewhere in Africa. And that family looks to me like the Ephraim family. I relate to it. How many people relate to this? Like you grew up in this environment, Simeon? Okay, great. Very good. So I could relate to that. I could see myself young and playful and joyful and hopeful. But when we talk about inclusion, we normally generalize and put a number on it. I'll tell you where that is. How many people would tell me where that is? By the show of hands. Okay, pretty much everyone. Mandela Square, Santon. Perfect. That is Santon. You see that map? I picked it up from my Google map. You see that road in between? That is M1 going through from Pretoria down to Johannesburg. Santon is on the top. And on the bottom is Alexandra. The first picture is Alexandra. I would like to call it, for the purpose of this presentation, Santon South. Now I'll repeat that several times just to relate to it. Now, when we look at inclusion in South Africa, we would tell you that in average we're good. South Africa there's inclusion. But technically, we're looking at that guy in Santon North, and we're finding an average number we're including that guy in Santon South, and we say in average we're good. The point I want to bring here is inclusion needs to be targeted. We need to be intentional as we talk about inclusion. Now, when we review the regulations or the mobile money regulations, we review it based on the key pillars that are known. So the GSMA mobile money regulation index, we looked it against the payment aspect for financial inclusion, PAFI, and we also looked at the FATF kind of measures. And if you look at the dimensions that we use to review the guidelines, the 6 dimensions are displayed there, all the way from authorization, consumer protection, transaction limits, KYC, agent networks, investment and infrastructure environment. Think about Santon North and Santon South. Now, the way you look at these elements for Santon South is very different from the way you look at it for the North guys. When we went and looked at it from a PAFI point of view, we looked at the public-private sector commitment, we looked at legal and regulatory framework, measure it against what our payment aspects are looking for, and we also subject it to the FATF requirement on AML, money laundering, terrorism financing, preventive measures, and the like. Out of that, we came out with what we call the mobile money regulation as it pertains to driving financial inclusion. Then we went across this SADC countries, spoke to all of the regulators, and at what kind of stack they are running. Now, if we agree that mobile money as part of the payment system or real-time payment system is an innovative solution, we agree that it is desired. At least we've seen that mobile money is driving inclusion through the aspect of access. So in all countries that have actually implemented mobile money, we agree that it is a driver of financial inclusion. It is desired. People use it. Is it feasible? Yes. There is feasibility on it. That's why it is deployed. And there's a business case. That's why businesses are actually implementing it. Now, if you look at real-time payment system, it is a suite solution. It actually is intended to drive aspect that will make life better. However, we forget that innovation is only sweet and meaningful if we move from one point to another. And I think what this actually reminds us is payment system competes with cash. Most of the guys says cash is free, and some of them says cash is actually not free. But when we think of that Ephraim family in Santon South, and you give them payment system as mobile money, they will tell you that at sometimes I'd rather use cash. Intellect did a nice comparison on different elements on cash, EFT, card, and instant payments. And when I talk instant payment, I talk mobile money and all other forms of payment. Mojaloop being part of the infrastructures. They look at it from a low cost aspect. And if you look at that, cash is very low cost. Think about the Santon South. That guy rather walk 2 kilometers to make payments on cash than using electronic money. Key things I'm picking is innovation. There's no innovation around cash. There's a lot of challenges around it. And yes, instant payment system have got innovation on it. How can we actually piggyback on that? And then safety and security. Yes, cash is not safe, it's not secure, and all that. But the question we have, why can't we launch a platform, a system that looks like cash, just like cash? Why can it not be without no transaction fee or limited transaction fees? And what we are trying to advocate for here is alternative business models that will still make providers profitable, but keeping in mind that guy in Santon South. No transaction levies in East Africa. All regulators and jurisdiction are trying to put taxes on mobile money specifically. Some of them we're doing them even for banking transactions. Why can't we think about new business models? We still need to be profitable. We still need to exist. We need to innovate. We need to make sure that there are business models that make sense to providers, but we also need to make sure that we address the Santon South guy. Regional integration is key. When you look at SADC as a region, we're not existing in silo. There are a lot of trade happening between country and country. And I think one of the things that the regulations are looking at is to drive that regional integration. FinMac Trust said if mobile money is a form of electronic payment that is backed up by funds in a trust account, should value can then be exchanged easily within a system and drive progress within it. Pulling out some structure within the regulation and referring to the Tanzania instant payment system, mobile money being a system that is embedded within the banking sector, e-money issuers issuing the funds backed up by electronic, by the trust account. But there are a lot of services in between there that can be integrated in. So what we learned was mobile money does not exist in silo. It has to integrate to a larger payment systems within the country and different aspects of it. When we look at payment stack, we learned that a number of countries are looking at it in 3 layers: KYC layer, the payment layer, and the data layer, whereby it allows us to then integrate with other sorts of data that would actually encompass the payment system. So in summary, the payment system in a country would be looked at that layer. Now, when I think of what Mauritius is running, and when I think of what Tanzania is running, I can still peg them on that structure. I'm picking this from the Tanzania instant payment system. I think some of you involved in this would actually remember this structure, but this also gives you a high-level ecosystem and players around the mobile money ecosystem. In the center of it being the e-money issuers and banks, but there's a huge element of services issued within the banking sector, but also the national payment system itself. Aside, they are sponsored DFSPs. This is whereby it allows innovation like payment initiation service providers interacting with existing payment systems, their integration with national ID databases, mobile money partners, the settlement accounts within the Reserve Bank, basically integrating within the payment system of the country. When we look at a regional play, borrowing from discussions that has happened mostly in this community, building on RTPS forums that have happened before, we believe strongly that payment system in a country would be connected to a national payment environment, and then that ultimately will connect to a regional payment environment. So technically, a country should actually be able to aggregate and make sure that payment happens smoothly within a country level, and that spinning off to a regional level. But most importantly, the SADC region has got countries that are part of SADC, are part of EAC, and some of them are part of EAC and COMESA. We're asking ourselves questions of how would SADC then connect to payment systems that are already happening, like the COMESA payment system, the EAC payment system is coming up. The elements around this regulation is to allow providers within this region to participate in payment system across regional systems. I'm quoting Michael Richards here. So Michael believes that within a regional payment system, one jurisdiction can actually transfer payment to another jurisdiction without actually breaching the data or the personal identifiable information. And the way we suggested, and thanks, Michael, for the reviews, I think a number of people from the community helped review this particular work. But what we're suggesting is, hey, it's still possible for South Africa to trade with Tanzania without having personal identifiable information compromised. And if there is a need to reveal that, there is a process that a regulator in jurisdiction one can ask for verification with the regulator in the second jurisdiction. What we consider as key success factors, again, remember, regional integration, KYC, use cases. We also remember Santon South and Santon North. We strongly believe of these things to be key success factors of implementing this regional integration. The KYC, SADC needs an integrated KYC. So if I am, which I am, Tanzanian, and I want to open an account in Zambia, I should be able to use my Tanzania national ID to register in Zambia, and the provider there should be able to authenticate me. Centralized registry will make life much easier. Regulatory collaboration, we do have different countries and they talk to each other, but there is also a lot of boundaries between these countries. So we need to make sure that there is integration at a country level, but also with regulators within the country to make sure that they drive the same agenda. Transparency in licensing. We've seen a lot of processes when it comes to licensing fintechs and payment services providers. If PSP is going to be the next wave of this, the licensing process needs to be streamlined. Oversight and supervision models needs to be friendly. Training and capacity building. Each of the 16 SADC countries are in different level when it comes to payment systems. And there's a lot of training that is required and capacity building, knowledge sharing, government to government kind of engagement that is required. Regulatory enabling environment to enable a smart and proactive oversight. Because we've realized that technology is actually going faster than the regulations. So having an environment whereby there can be smart regulations or a way of performing oversight that will keep the regulators up to speed with the innovation in the market would really help. Data privacy is key. And basically different jurisdictions have got different laws. And we need to make sure that the SADC Secretariat is making sure that those are streamlined. Cross-border transfer and interoperability is key. COMESA is way ahead of the game here. EAC is coming. SADC is not left behind. There's a lot of discussions around SADC doing cross-border interoperability, and we were not blinded by the fact that there are other regions that are already moving, and we will actually build on those. Issuance of mobile money fees and new business models. I think this is key. Mobile money is great, but hey, let's face it, it's becoming too expensive when we talk about payments. Now there's a whole model around money transfer, and we can argue that it's actually changing the way money transfer was done. But when you talk about payments, merchant payments, and all other business models around it, there's a need to review those fees and look at the way mobile money can participate to make sure that the guy in Santon South can also participate in the economy. Finally, other use cases, savings, lending, and other payment services that users can get. Normally we say, bring them on board and give them financial services, but we're not intentional. We cannot offer a guy in Santon North the same services that a guy in Santon South need in an efficient way. If we could actually address those 10 factors within the region, we strongly believe that we would have driven inclusion using real-time payment system in that particular region. I will take a break there. In SADC, we have to say asante sana because I'm from Tanzania. Merci beaucoup because they are French-speaking people. Muito obrigado because we have to talk to the Portuguese. And thank you because I'm talking to you. If there's any question, it's time for questions. Simeon, I do have 8 minutes. I'm happy to take a question. Or a comment.
Just a comment. I just wanted to say very, very nice presentation. I think I really resonated with their presentation, maybe coming from a country that is also has a lot of mobile money. So brilliant presentation. Thank you.
Great presentation. I would expect no less. So I wanted to ask a question about cost of cash. We hear a lot about ways of reducing the cost of operating mobile money systems. And the cost of cash to governments is substantial. We heard yesterday about the amount of money that governments spend printing notes, the amount of money that's spent distributing cash. And of course, for governments, cash versus digital money represents a significant loss in relation to, shall we say, tax revenue. The question I want to ask is, why does nobody say, why don't governments share some of the benefits from replacing cash with digital finance with the stakeholders? Why aren't they subsidizing the cost of these systems? Because they're making it back.
Good question, Michael. And so I'll thank you very much, sir. I really appreciate. But Michael, that's what we're trying to drive. So this particular guideline is to try to drive the CCBG, the Commission for Central Bank Governors, to start taking that stand, right? So yes, the cost of cash is high for the government. But if we look at mobile money as a pioneer in this kind of payment system, they would actually tell you a different story because they are there to make money, totally understand. And the business models must be sustainable. And finally, the business models, which is something that we brought up clearly, is to say, can we look at the business models in a way that the cost of transaction itself can actually be subsidized because they're making money somewhere else? But the discussion around government subsidizing this because it's cheaper to do digital than cash is a critical discussion, especially when governments now are putting taxes on mobile money transactions, right? So you're not only with what we're essentially saying, we're not only telling them that you're going to lose the tax revenue you're charging now, but we also say that subsidize the revenue that providers are actually making. That is why we tried to bring in an essential element of this when we brought in the Santon South person. And we said, yes, it makes sense when you look at the Santon North, but when you look at it from this particular level of a provider, it makes sense for a government to build a case that I want to subsidize this because it does not make business sense for the guy in Santon South to transact, but also it puts me in a blind spot. In South Africa, we EFT, if I send money from my bank account to your bank account and you're on a different bank, that transaction is technically free. It's not real time, but it's free. If it is a faster payment, in other words, you get it immediately, they will charge me a minimum amount to facilitate that. Now, if EFT can be done free, seriously, why wouldn't a Santon South person pay at a restaurant with mobile money free. Right. So from a government point of view, it makes a lot of sense for them to subsidize it because it's cheaper than printing notes and replacing them and all that. But also, if they look at it from inclusion point of view, it makes a lot of sense. And what this guideline tried to do is to look at it from a user point of view to say, hey, it makes more sense to look at it differently for this group. I don't know if I answered your question or I found that out.
You answered it in the sense that I never doubted you would have got here months ahead of me.
Thank you.
Yes, I do have a follow-up question, a little bit related to what he has raised. You know, as you spoke, I kept wondering, what are those specific interventions that can really bring down charges? Because this is a real pain. I come from Uganda, and this is an area that is really, really giving us headache. It is easy to say, fine, government could subsidize, but if you cross if you put yourself in the shoes of the government, you have a PSP that is reporting a return on total assets, way above what any other financial service provider is reporting. Then the question of subsidizing becomes very, very difficult to even front as an idea. So from your experience and the work you've done, what are those potential policy interventions apart from subsidy from government? How else could these charges be brought down, especially given what we see in some markets where the returns are really, really high?
Yeah, I think that's a good question. Now, I would look at it from a government cost point of view. I think Michael is coming from a position that says it costs the government a lot to print notes and coins. It costs them a lot to print those. If they apply that cost on digital, probably they can issue this for free. So the governments are spending a lot to print notes and coins. And when they're out there, the payment with cash is free. You ask about what interventions can be done. Within the SADC, most of the SADC countries and some EAC countries are already talking about interest payment or distribution of interest to mobile money users. In other words, the money that sits in a trust account earns interest. That interest is distributed to users based on some formulas that they've stipulated. A number of jurisdictions argue that probably will stimulate savings. In other words, I will choose to use mobile money because at the end of the day, I'll get some interest out of it. Now, some jurisdictions are already moving away from that to say, actually, it does not drive the savings behavior. But what we're trying to put on the table is to say, if the trust account earns them X amount of dollars, those revenues you're talking about, can you swap those with the costs that the Santon South customer is spending it on? So if we can intelligently break down these transaction bands and say, if you're paying this kind of transactions, it will be free. In other words, we are intentionally looking at that particular customer, right? And use cases within the payment systems are different. So money transfer is very different from merchant payment. And we should actually have different business models for those. So one of them is to see how we capitalize on interest payment. But secondly is just drive the thinking from a user perspective. So if they think about it from that perspective, they would actually come with business models that will suit them. Thank you very much. Or I will definitely take Elizabeth before you, Michael, and then I'll go down.
No, thank you. I just want to add, I think is a potentially complicating part of the equation. Certainly, governments do have costs to print money, right? And of course, high velocity of money is a lot more cost to that. There's also, that's clearly a cost. Yeah. There's also a revenue side of currency to governance, and that's seigniorage, right? The cost between the difference between what it costs to print or coin and what they sell it for, the nominal value. So there's revenue there for governance that is very often not considered because it's not so obvious to us. So that just needs to be in our minds as we think about proposals to put forward to the government. That's all I wanted to share.
Thank you. So can you give me back my presentation, please? Michael, I'm gonna give you. Can somebody give me back my presentation?
Can you put the slides back up, please?
Great. So, yeah, you could take my details there if you want. My clicker is not working. Okay, perfect. So, Elizabeth, as we're talking about all that, and I think I purposely did this, with the cost structure, we really must think of these guys. If you think about this person, we can then start talking cost, right? So in no sense that we will say change the business models and cripple the providers, because hey, it needs to be sustainable. Otherwise, there's no innovation. But as government, as financial inclusion advocates, as people want development, if we do not cover this person, we're actually burying this guy in debts. He will never get out of that. He will not adopt payment systems because there's no way it makes sense to him. So when we think about looking at business models, we really need to be intentional with the kind of customers that we're serving. That's all I can say. Michael, I'll take you and then I'll run out.
Okay, so I have a very short comment to make, which is going back to the discussion you were having just earlier about subsidizing. One thing that we could use tiered KYC for is to distinguish and say, for instance, people in the lowest tiered KYC band would pay nothing for transfers. The government would subsidize that. People in the higher bands would pay a sliding scale on transfer. So instead of transfers being set at a single level, as they currently are, I think, by mobile money companies, they could use tiered KYC to target interventions in relation to the poor.
Thank you, Michael. I think I take that, and thank you very much all for listening to me.
Thank you.